Hello everyone, this video recording is a continuation of our chapter 11, that is the budgeting. If you recall then from the previous video, we did up to the manufacturing overheads, trying then to explain using then the given example. But as I've asked you then on that video then to do the question 11.1, that is 11.1a up to your manufacturing overheads. So we will start looking at the solution of that today before we carry on to the next projects. So that's going to be our starting point for our video recording. If then you've already done those solutions, then that is good. Then you'll be able then to mark yourself and see if what you've done is correct to what level. But if not, I think it will help you then to understand what you were supposed to do. I've tried then to attach those copies here in my slide presentation. Just as a reminder, this is where we end our last video, that is on our manufacturing overheads budget. So we will carry on from here. As I've already mentioned that before, then we move forward and we will look at this question 11.1 and start then to do then the solution of it. So as a recap of what then we have already done then in the previous video. So this question reads, a company manufactures 3 products, A, B, and C. It is expected that sales quantity are likely to be 3,000 units, 4,000 units, and 5,000 units respectively. The selling price calculated for each of the products are 100 Rand, 80 and 70 respectively. Prepare the sales budget. Remember again, we said that then this is a foundation budget. You have to make sure that everything then that you are doing on this budget then is accurate as much as you can, because you are laying a foundation for other budget. As you've seen, then this is then one of them, the easy exercise. So this is going to be very easy then for us and to do it. So 11.1a. So you've got then your products A, B, and C. We start looking at our sales units. So we're given 3,000, 4,000, and 5,000. So those are our sales. We multiply then by the selling price per unit, which is 100 rands here, I think it's 80 here, and the last one is 70 rands. So that's easy like that. Then you simply do then your multiplication, and you'll have then the sales amount or sales value, whatever then term then you like. 300,000 on this side and 320,000 on product B, and the last one is 350,000. Then, excuse me, then you're done with your requirement A. That's your sales budget. You can collect then all the masters that have been allocated there. Then let's look at 11.1b with our question. Now looking at 11.1b, it reads, using the data from question 11.1a, prepare the production budget assuming that the opening inventory of products A, B, and C are 1,000 units, 500 units, and 750 units respectively, and the company plans a 10% increase in finished goods inventory at the end of the period. So that's the information. So it's a continuation in a form 11.1a. So we do then the production budget. As we've mentioned then that when we look at then the production budget, Sorry for that. It's 11.1, but then B. So in our production budget, what we want then to check then is if the company does have enough capacity then to meet then the sales target. So again, it's going to be your A, B, and your C, then the columns. And your starting point here then is going to be your estimated sales. Remember, we said that then whatever then that you record in this budget, it must be the quantity. So again, I will start with the sales units. So you've got 3,000, 4,000, and the 5,000. So what we need then to do, we need then, because we want to check then what must be our production in order then to meet this sales target. So we said, let's bring back the closing. Your closing inventory. What's the story about the closing inventory? Go back then to the question. They say here then about the closing. The company plans, if you look at that, this is then the plan. The company plans a 10% increase in finished goods inventory at the end of the period. So it means then this 10% we're going to factor it in our opening. So your opening for product A, it was 1,000 units. So then we need then to add the 10% to this, and we're going to add another 10% for product B and another 10% for product C. So then to arrive then to our closing inventory. So a 10% of 1,000 units, so it's going to be 1,100. Then a 10% then of 500 units is 50 units. That gives you a 550 units. 10% of 750 units, then that's going to be 75. Then you add then to that 750, then it takes you to 825. Then that's going then to take to production then that is available. So you'll have here then now 4,100, and on this side then you've got 4,550, and this side is 5,825. Then you take out your opening. And reasoning being then to take out this opening, because this opening is not then what we've manufactured currently. Because what we want to check then with the production budget, we want then to check then our current production. So that's why then we decided then to take out what does not belong then to this current production. So that we can see, okay, now how many units must we produce currently to meet then our target sale. Production units or your production required, so it's 3,100. So if then we manufacture 3,100, we manage then to maintain our level of stock and also then achieve then the required sales. This side we've got 4,050, and this side you've got 5,075. So then these are the units then that you need. So then that's your 11.1B. I hope then it's clear then to everyone. Let's quickly move on then to 11.1C. And C then what's the question, because that's C. Then the question then reads, using the data from question 11.1A and B, as well as the additional information below, prepare the material usage budget, assuming that products A, B, and C use material alpha and beta to produce the three products. That's where then the problem then start. Because remember, look at here, then you've got three products. and you are using then these two raw materials to each and every product. So you need then to make sure then that you do account for that, because product A uses alpha and beta, product B uses also alpha and beta, and product C uses the same raw material alpha and beta. Then the opening inventory level for alpha and beta are 500 units and 1,000 units respectively, and the company plans to increase the closing inventory to 2,000 units of alpha and 1,750 units of beta. Material used in manufacturing the products are as follows. So you've got your quantities then per unit. So for product A, we need then 5 quantities, because I cannot say then 5 kgs or what, because it's not given here. They just simply say that these are the material that we use. So we can safely name them as kilograms. That's fine. We are not making any sin by doing that. So you can say then, okay, to produce product A out of alpha, then I need 5 kilograms. Then for the same product, then I take 2 of product raw material beta. B, then I need then 2 kilograms of alpha and 1 kilogram of beta. Product C takes 2 and 3. So that's the information then that we have. So you need then to be very careful here, because it means that you need firstly to do the collection of your material. So the material required. So that's what you have to work out first before you can add your closing and minus your opening. So that's what you need to do. All right, let's get on and see. But how are we going to do then this raw material budget, which is 11.1C material budget. Now in this case, we've got the raw material. Remember that in the our exercise that we've used, we changed the columns when it comes to the material, and we've opened them with alpha, and then you've got beta. So that's how then you open up. So I think then the best way, guys, then is to start with the workings. Just do your workings first before you can carry on then and actually do your budget. So using this raw material, that is raw material alpha. Using this raw material, I think this will be fine. We produce product A, product B, and product C. And again, this side you produce product A, B, and C, using again that raw material beta. So hence of opening up these columns. All right. So we start with the production. You take your production required for product A. Then looking from your production budget, this is your product A. We need 3,100. So you'll put your 3,100 here, and again 3,100 this side. For your product B, what am I doing now? Now for your product B, that is 4,050. That's your B 4,050. That's your production required 4,050. And your product C, then it needs 5,075. 5,075. That's it. Then you come to this information that is given for you that you'll make use of. Okay, to produce each and every unit out of product A, then how many kilograms of alpha then do we need? So we know that for product A, out of alpha, we need 5, then 2, then 2 beta. Then we go and multiply by that, times the kilograms. So we say then for alpha is 5, but this side is 2. Then for product B out of alpha, then we need then 2 kilograms, and on beta is only 1 kilogram. Then for product C, then is 2 this side and 3. I hope then you do follow then what I'm doing. Remember, we still say that these are just then our workings. We are just doing then the workings here to calculate then the number of kilograms. So in other words, we are converting now then the finished goods back then to the raw material. That's why then we have then to do this exercise. So this side then your number of kgs then to produce this 3,100 will be 15,500. So for coming then to product B, 4,050 times again by 2, then that's give us 8,100, 5,075 times again by 2, then that takes you then to 10,150. Again at 3,100 times 2, then it will be 6,200. Then this one won't change, same 4,050, and you've got 5,075 times and 3. On this side, then you've got 15,225. So these are the number of kgs, guys, that we're looking for. So again, now you can go now and do the actual budget that we're looking for. We have then to do, that is alpha. Wait. Now we can do then the budget. So our starting point then will be, guys, now the number of kg, because if then we start then with the production required, it means that we are redoing then what we've already done here. So then to do the number of kilograms, you need then to add then the 3, that is ABC. We have then to combine now all of then those kilograms. Plus 8,100 plus 10,150. And the reason why then we combine is because we are producing then these 3 finished, these 3 units out of this product. So that is why now we need then to get the combined or aggregated total units. So it's 33,750. Then on this side, it's going then to be, if you take 6,200, 4,050, 15,225, it gives us 25,475. So then that's going to be our total kgs. So we're in a better position now than to say plus the closing. Closing inventory, looking then at our exercise we're given, then the closing, a story about the closing market, then the closing inventory of 2,000 and 1,750. So then that's what you'll take there. 1,750. And let's take you then to the material available. Of 35,750. And this side 27,225. Then we minus opening. Then our opening, we're given this raw material. We were told that is 501,000. Then that will take us then to our material usage. Well, this is what we are going to use in our production, which is going to be 35,250 on this side and 26,225. So that's going to be your material usage that we have. So then we can also develop then the material purchasing budget. If you look at then the next budget, that is D, which is then your 11.1 D. Excuse me with that. He said using the material purchases budget, prepare for question 11.1C, or prepared for question 11.1C. Prepare the material purchases budget, assuming that the unit cost of alpha and beta are R2 and R3 respectively. So to do then your material purchase, it's like again you're doing then your sales budget. So you'll take then your material usage, multiply then by price per kg or a unit of a raw material, of course. So our material usage, we're given 35,250, that's what we've calculated, and 26,225. We take that 35,250 and 26,225. Multiply that by 2 rands, and on this side times by 3 rands, the prices that are given for us. Then you've got your purchase cost. We are on alpha, then our purchase cost is going to be 70,500. Then coming then to beta is 78,675. Then you're done now with that budget. That's it. Let's move on then to the next budget, that is 11.1E. They say now using the production budget prepared for question 11.1B and the information given below. Prepare the direct labor budget assuming that 2 categories of labor are used, assemblers and finishers. The standard times per unit and budgeted standard unit rate are as follows. Then in the assemblers and finishers, then now is R6 per hour. So again, you've got product A, you've given its hours, product B its hours, and C respectively. So that's the information then that is given then for us. Excuse me. So again, when it comes into this, I don't think the spaces will be enough. 11.1 E. The labor budget. So the best way again then to do this this labor budget is to go back again and do A, B, and C. For then it will be able then to allow us to do our calculations correctly. So looking again at this information, we need again then to do a collection first. So we've got then the little bit of workings then that you need then to carry on here from then the production that we have. Because then in this case then we've got two sets of, so we need then to work out then for the number of hours. So once again we have then to do then the workings. Oops, this space won't be enough for me then to do then these workings. Let me do this. For our workings, because we have then to do the collection of then the hours. Remember here then we've got then the assemblers and we've got then the finishers. So we need then to take that into account. Say then for product A, we use then both of them the labor for to produce product A. So for product A, remember again our starting point again is the production required. So we got then our production required from the production budget. And it was for product A 3,100. 3,100. Then you simply multiply then this. I need to open up then the space a little bit more because I'm trying then to save then our space as much as we can. All right, then this will be fine. So we said that for product A, we've got just 3,100, 3,100. But here now we'll multiply then by 5 hours. Then, but this side then, because the finisher side then for product A, if you can go back to the question and look, guys, and but the number of hours that you have there, these are the hours that are given for product A, under then who assemblers is 5 hours, but finishers then you've got 2 hours. Hence, then we have to multiply then by 2 hours this side. Then for product B, your production required was 4,050. Then you multiply by the number of hours, 2 hours and 3 hours. So 4,050 times 3 hours. These are your hours. Then for product C, you've got that 5,000 and excuse me, 75. 5,000 and times then the number of hours. Go and check the hours. You've given 1 hour and 3 hours. Times 1 hour and 3 hours. Then and see then how many hours then do you have? That means it's going to be 3,100 times 5, 15,500 this side. Then again, here then 3,100 times 2, then that gives us 6,200 hours. So by doing this, guys, then we are converting then the production required into hours so that we can be able to multiply then by the rate. So this side 4,050 times 2, then it's going to give you 8,100 hours. 4,000 times 3, then it's going to be 12,150 hours. Then 5,075 times 1, that's 5,075 hours. So no longer units now. Times 3, then it gives you 15,225 hours. Then you can add then this and said, okay, I've got a total this side on the assembly of 28,675, and this side you've got 33,575. So these are your total hours. So then this come back then at your original budget, and once then you look at this calculation, guys, then it suggests is that now also it will be best also to open up then our columns with then the departments that we have, the 2 departments then that we have then, not then with these hours, because if we done that, it's going to give us something else. So you've got your assemblers and your finishers. So these are the total hours required. So we'll take then those total hours. Required, we know here that the total is 28,675 and 33,575. We simply multiply then by the rate per hour under each then department. And we were told that the rate under each department is 6 rand here and 7 rand then in the finishers. So we will take then those rate times 6 times 7 rand on that side. Then that gives us a total of 172,050. And this side you have then now your 235,025. And you say that this is my labor budget. So if you like, then you can add then and get your total. That's up to you. If you want then to do it like that. Right, the last one that we will look at it, that is 11.1F. Using the production budget prepared for question 11.1B and the information below, prepare the manufacturing overheads cost budget, assuming that the predetermined overhead rate are as follows. For a variable overheads cost is 2 rand per direct labor hour. For a fixed overheads is 1 rand per direct labor hour. Oh, what does it to do? The manufacturing overheads. So that's your 11.1. So 11.1F. Your manufacturing overheads. We start then with the variable. So you've got your A, B, and C, that is your products. When you do then this manufacturing overheads, because we've already been told, guys, and that we are using then the labor hours. So then let's just then go, because we've already calculated then the labor hours. We know then the labor hours required for each and every department that we have here. So we'll simply then make use then of those labor hours and then do then our calculation. So we know that then for product A is 15,500 and 6,200. So you simply add then the two. That 15,000, excuse me, 15,500 plus the 6,200. So then we simply said, okay, we'll take our total labor hours for A is 21,700. Then to do labor hours for B is 8,100 plus this 12,150. Then it's going to give us 20,250. Then the last one is 5,075 plus 15,250, because we add then at the both department. So it gives you 20,300. Then you multiply then by the rate, that is your variable manufacturing overheads rate, not just any rate that you just think of. So we've given 2 rand and 1 rand in the fixed. Multiply here by 2. So we'll multiply then by that 2 everywhere, guys. Because then the variable as it just this absorption amount, it goes in to all of these products. So it's 43,400 here, 20,250 times 2. Then that's going to give you 40,500 this side, and times 2 there is going to be 40,600. That's it. Don't get tempted when it comes in to a fixed and say that let me just combine then at the rate and just take then this rate of 2 rand and say now I'll add the 1 rand of a fixed. So we are multiplying here, we're not adding. So once then you do that, it's going to be something else. So again, you'll take your total labor hours, same hours, 21,700, 20,250, 20,300. Multiply then again by the rate, the fixed manufacturing overheads rate, which is 1 rand across. And it won't change anything, 21,700, 20,250. We only put in the sign, the rand sign, 20,300. So if you like, you can add then at the end the totals here and these totals and combine again and have then at the full total 50 manufacturing overheads. That's what you can do. All right. So that's how far then we go for with this exercise, as we did in our last video, and I've asked you then to do this. So this is then a good reminder then of then what we've done. So we will move on then with the next budgets that we have to prepare in our master budget. So the next budget that we are going to talk about is your selling and administrative cost budget. So that's the next budget then that we will look at it. So they say that the selling and general administrative cost budget contains all non-manufacturing costs expected during the budget period. The sales manager is responsible for the selling budget, the distribution manager for the distribution expenses, and the chief administrative officer for the administration selling or budget. Selling, distribution, and administrative cost can be expressed as a percentage of sales or predetermined rate per unit sold, can be used to determine the budgeted selling and administrative cost per period. So this is one of them, the easiest budget that we have. So looking then at that example then that we have on that page 250, we started 256. What was the story then about the selling and admin budget? Selling and admin. Looking then at the information there. All right, just then before the requirement, they say the selling and admin cost amounts to 1% of sales. So in this case, we are using a percentage. So you'll simply go then to your sales revenue, which is 140,000 and 440,000 on each basis, and you simply calculate 1% of that, as you can see. So the selling and administration budget have been combined here then to simplify the presentation. So that's it. So sometimes then it means that they can split it, so you have them to do it one by one. All right, then again, we've got a closing finished goods inventory budget. Then once then the 5 budgets have been completed, the information needed then to determine the production cost per unit is available, because we can be able to use then the previous budgets so that we can know then the cost per unit is how much. This is necessary to determine the cost of sales. That's the reason why you have then to work out on a cost per unit budget, as well as to determine the value of the unsold products that is placed on the balance sheet. This is done as shown in table 11.7. So this is then now then our solution then for the production cost per unit. So if then we look at our raw material, so our raw material, if then you still remember then in our material budget, we find that to make then now the top, then it takes us then 0.4 kgs and 1 kg of a wool. So multiply then by the rate of then the cotton yarn, which is 50 rand and 100 rand in a per kg of wool. So then we've got 20 rand and 100 rand. Remember now we're working then with the cost per unit. So that's the cost per unit. Direct and labor. So we want then to know, okay, now per product is how much, and our labor cost. Again, the number of hours we take then to manufacture then the cotton drop is 0.4 times then at the rate, which is 120. Woolen jersey is in half an hour at the rate of 130, so you've got 48 and 65. So your prime cost will be 68 and 165. Move on then to your manufacturing overheads. In manufacturing overheads, we use then again the labor hours to absorb them, hence then we've got that 0.4 times then 40 and 0.5 times then that 40 again. So you've got 160 and 120. We had also a 50 manufacturing overheads, which was 12,000 by 12 months. It gives you then the amount. These were, if you can go back and look at your direct labor budget in this exercise, these are your total hours there. Direct labor budget, we've got those hours on that budget. So 854. So we take then this amount divided by 854. So it gives us 168.62 per hour. But we're not looking now for the cost per hour, but we're looking for the cost per unit. Hence, we move on again and take that 168.62 multiply by 0.44, it drops and multiply by half an hour for the woolen jersey. So we've got to 67.7445 and 84.31. So all in all, this is an hour cost per unit that we were looking for. And with this cost per unit now, we are in a better position than to do then the cost of sales budget. Before then, we moved then to the cost of sales budget. We first started with the finished goods inventory budget. So you take your closing inventory as they appear then on page 258. So that is in your top center. You've got a closing there of 20 top center that you assume that are going to be your closing. And in your woolen jersey, 80 is your closing there. And you multiply with this cost per unit of 151, then into 268, the one that we've just worked out here. And you simply use that, and it gives you then your total closing inventory. Then you can be able to develop then now the cost of sales budget, where they say the cost of sales budget is drawn up from the information in table 11.3 to 11.8. And the value of finished goods on the balance sheet of the previous period, that is the opening stock of finished goods inventory. A simple formula can be used when there are no changes in the cost of direct material, direct labor, or manufacturing overheads budget. So to do the calculation of cost of sales, where you'll simply say take your cost of your opening inventory, finished goods plus cost of goods manufactured, you minus then the closing inventory, then it will give you what you are looking for. But if there were changes in any of the above mentioned costs during the budget period, then the format shown in table 11.9 is used if you can check that table. So take note that the opening inventory is added and closing inventory is subtracted on that table. So this is the table 11.9 that we are talking about. So, but we are going then to just going through then the solution of then this exercise 11.1 and see then how then it's being done. So this is another exercise that we have. So probably then to have a better understanding, it will be nice then to have your textbook next to you so that we can see, you can see then these values, because I can't keep on going back to the question here on this presentation. So we start with the direct material used for production. So opening inventory, cotton yarn, they have got 6 times 50, and here then we've got 5 times then 100. If you can go and check on page 258, that's where you'll see then, okay, now this is the opening that we're talking about. Is there this opening of 6 units or 6 kgs in your raw material there? Is 6 kgs, and you've got then your 5 kgs of your wool yarn, multiply then by the cost, it gives that 300 and 500, plus then your purchases. If then you've already done then the material purchase budget. So this amount, if you go then and look at your material purchase budget, that's where then this amount is being taken from, this 128,100 from your direct material purchase budget. Then we minus from this amount the closing inventory. Now remember again, we're still talking then here about then the raw material. Cotton yarn, you've given on page 258, that's that 10 kgs and 2 kgs of wool, multiplied again by the cost per kilogram, 50 and 100. So it gives you then that 500 and 200, which adds up to 700. So we've minus that, so it's 800 plus 128,100 minus 700. So your direct material used for your production, 128,200. Then we add direct labor from the labor budget. That's where you'll have then that 108,180. So this is from the labor budget. You've taken it from there. And it gives you a prime cost of 236,380. And this one we say that is from material purchase. That's from your material purchase budget. Then you move on then to your manufacturing overheads. Want then to finish up then our production here. Manufacturing overheads, you've done now the manufacturing overheads budget, and you've got this amount. 178,160 to arrive to your total manufacturing cost of 414,540. Then you adjust then for your finished goods inventory, looking at your opening inventory from December 20 times 7 statement of financial position. It means on page 257. That's where you have then that information. So you've got then for Cotnian is or your finished product there is 7,058. That's the 7,058. Then you do then the closing of inventory. Your closing, then we are given here that our closing inventory, then we've got this 20 and 80 units times then that 151, 3,029, 80 times 269, 31, then it gives you that 21,500. So you've got a total of 24,574. One will say that why the need of then redoing the calculation, but it's a matter of showing it in the calculation because this is the calculation that we've already done here. So this is then the repetition of what was done. So this is where then this 24,573. So you can just simply take that. Oh, then it's fine. Then you can redo it again. Then and have that. So you adjust and you have got a negative 17,516. You minus it from there. Then that's your cost of sales, 397,024. So that's the last budget. Then in your master budget, then you can safely say that now you've done that. You can just do the test of that master budget by taking in your 700 and your 1,100 woolen jersey. That is your sales. So you do then your test in this calculation by taking opening inventory, 10 tops and 40 jerseys, current year's production 690 times then 150. Now 1,060. One I will ask them, okay, why now we say that our production is 690? If you can go and look at your production budget, in your production budget, it shows as the production required is 710. But why then we've got then 690 there? So you can take then that 710 and you simply then take out the closing, because then that closing, then we say that out of this production, but we'll keep 20. So take out that 20. So that's where you've got that 690 and also 1,140, take out 80. Then you've got then that 1,060. So because our understanding, we said that, okay, probably we're using first in, first out. Hence we say that the opening, so short is going to be part of your sales. Hence, then we take out then the cost of that. So we said, okay, from the current production, let's take out then the closing and multiply then with the cost per unit. So you could see then a small difference then is because of then the issue of then the round of thing. Otherwise, it was supposed then to be exactly as this 397 and 24. And here you've got 397 and 28. So it's a small difference of 4 rands only. So that's it. That's the budget then that we're talking about. So I'll simply ask you then again, because we're going to stop then our session here. So I will ask you then again to finish up then that 11.1. So by doing G and H on your own, then next time before then we move on then to what we call now flexible budget. We'll quickly look at the solution of those two, then we move on. And secondly, I've also attached for you guys a tutorial exercise on Teams. Go and look at your files, then you'll find then the tutorial exercise there. Please try then to attempt that exercise. It's going to assist you. But next time we will move on then to the flexible budget. So this is then the master budget. So two exercises, so to speak. We've done it. So you've got then the third one that you have to do it on your own. So the next one, the next time then we meet, we move on then to the next. So forget about the cash budget. Remember, we said that we're not going to do then that cash budget. Then this brings us, guys, into the end of the video. Make sure then you attempt the two exercises, and when we meet again, or when I do then the video again, then I'll show you then now the solution of that, then we move on. Thank you very much. I hope then at this video recording, it will assist you to have an understanding of then the master budget. Thank you. Bye.